I want you to listen carefully because what I am going to describe is not a headline problem. It is a system problem. There is a very large debt load sitting on top of the American economy. People argue about the exact numbers, the politics, and the personalities involved. But those arguments often distract from the basic reality. The United States has promised more than it can easily pay for through ordinary growth, ordinary taxes, and ordinary spending discipline. When a country reaches that point, the system does not usually announce a crisis in plain language. It does not say to savers, workers, retirees, and small investors, "Your money is going to be quietly diluted now." It uses technical words. It uses central bank language. It uses phrases like liquidity, balance sheet normalization, nominal growth, real yields, and policy flexibility. But underneath the language, the mechanism is simple. When a government has too much debt and the debt cannot be honestly reduced through taxes, spending cuts, or fast real economic growth, the burden is usually reduced by lowering the real value of money over time. That is the part most people miss. They think the question is whether the government will pay the debt back. That is not the right question. Governments that control their own currency rarely default in the simple way a household or a business defaults. They pay in a currency that they can create. What will the money be worth when they pay it back? That is the question that matters to your savings account, your retirement account, your bond portfolio, your house, your wages, and your standard of living. Most people will not think about this seriously. They will hear a large number, feel worried for a few minutes, and then return to doing what they have always done. They will leave too much money in cash. They will think a bank balance is the same thing as wealth. They will think a 4% yield means they are safe, while the real purchasing power of that money is quietly being taxed away. I am not talking to people who only want to feel safe. I am talking to people who want to understand how the machine works. Because in every major debt cycle, there are two groups. There are people who are acted on by the system, and there are people who understand the system well enough to position themselves before the system acts on them. The difference is not luck. It is not intelligence in the academic sense. It is the willingness to look at reality without flinching. The number at the center of this story is the national debt. Whether you hear 34 trillion, 39 trillion, or some other updated figure, the precise headline number changes, but the principle does not. It is enormous, it is compounding, and it is no longer just a political talking point. Debt becomes dangerous. When the interest on the debt begins to crowd out everything else, that is where the United States now sits. The government is paying an enormous amount every year simply to service the debt. That money does not build roads. It does not improve schools. It does not increase productivity. It does not create new factories. It does not make the population healthier or more educated. It is simply the cost of having spent money in the past. Think about that carefully. A worker earns money, pays taxes, and a significant share of those taxes goes not to the future, but to the interest on the past. That is how debt traps work. At first, debt gives you flexibility. It allows you to spend more than you earn. It allows governments to cushion downturns, fight wars, support citizens, and stimulate demand. But if it grows faster than income for long enough, the debt changes from a tool into a constraint. In my framework, this is part of the long-term debt cycle. In the early part of the cycle, debt growth feels good because spending rises faster than income. Asset prices rise, people feel richer. Governments feel powerful, businesses expand. Consumers borrow, politicians avoid hard choices. In the later part of the cycle, debt service rises, productivity cannot keep up. Social conflict increases, and the system starts looking for ways to reduce the real burden without saying it directly. That is where financial repression comes in. Financial repression sounds like an academic phrase, but the mechanism is not complicated. It means holding interest rates below the rate of inflation for long enough that savers and lenders lose purchasing power while borrowers benefit. The largest borrower is the government. So when real interest rates are negative, the government is being helped and savers are being quietly taxed. This is not done by sending you a bill. That would create anger. It is done by making each dollar buy a little less each year while telling you that your account balance is still intact. The number on the screen may not fall, but the amount of life that number can buy falls. That is the tax most people never see. It is also why the conversation about the Federal Reserve matters so much. People often talk about the Fed as if it were a simple government department. It is not that simple. The Federal Reserve System is a hybrid structure with public authority and private banking connections. It is designed to sit at the center of the monetary system, influence interest rates, control liquidity, and act as the lender of last resort when the system is under stress. The important point is not to turn this into a conspiracy. Conspiracy thinking often makes people emotional and less accurate. The important point is to understand incentives. Central banks exist to protect the functioning of the financial system. The financial system is built around credit. Credit depends on confidence. Confidence depends on asset prices, liquidity, and the belief that debts can be rolled over. So when the system is under pressure, central banks tend to choose the path that keeps the system functioning, that usually favors asset owners over cash holders. It favors those who own productive businesses, scarce assets, and claims on real cash flows. It punishes those who hold money passively and believe that nominal stability is the same as real safety. This is why the argument about a new Federal Reserve chair or a possible change in policy direction is less important than the deeper pressure behind it. Whether one person becomes chair or another person becomes chair, the debt arithmetic remains. The political constraints remain. The need to keep the system functioning remains. Personalities matter at the margin, the machine matters more. When people discuss someone like Kevin Warsh or any other potential central bank leader, they often turn the discussion into a dramatic story. They say there is a secret plan. They say the debt will be canceled. They say a specific rate target is guaranteed. They say a precise date will change everything. That is not how systems usually work. Big systems rarely turn on one date. They drift. They pressure. They adapt. They change incentives. They move through gradual policy choices that look small individually but become enormous over a decade. That is why I would not focus on a viral claim that one person will cancel the debt. That is the wrong framing. The more accurate framing is that a highly indebted country has only a few ways out. It can tax more, it can spend less, it can grow much faster. It can default or it can reduce the real value of the debt through inflation and negative real rates. That last path is often the most politically acceptable because it is the least visible. Tax increases create visible enemies. Spending cuts create visible pain. Default creates panic. High real growth is desirable but cannot simply be ordered into existence. Inflation combined with controlled interest rates is quieter. It spreads the cost across savers, wage earners, bondholders, and anyone who thinks in nominal dollars rather than real purchasing power. That is why it is so powerful. To understand this, look at what happened after World War II. The United States came out of the war with a very large debt relative to the size of the economy. Many people feared the burden would be impossible. But over the following decades, the debt to GDP ratio fell dramatically. That did not happen because the country simply paid down the debt like a household paying off a credit card. It happened because nominal GDP grew, inflation helped reduce the real burden, and interest rates were kept in a controlled environment that made the debt easier to carry. The number of dollars did not disappear. The value of the dollars changed. That is the lesson. When you owe money and the money becomes worth less over time, the real burden falls. When you own cash or fixed low yield bonds and the money becomes worth less over time, your real wealth falls. The same mechanism helps one side and hurts the other. This is why financial repression is not just a government policy. It is a wealth transfer. It transfers value from savers to debtors. It transfers value from people who hold cash to people who hold scarce assets. It transfers value from those who think in nominal terms to those who think in real terms. And it transfers value from the financially passive to the financially prepared. That is the part I want you to understand deeply. Most people do not lose wealth suddenly. They lose it quietly. They lose it by staying in the wrong asset at the wrong point in the cycle. They lose it by mistaking low volatility for low risk. They lose it by believing that because their account balance is stable, their standard of living is stable. But purchasing power is the real measure. If your account balance stays the same while the cost of food, housing, insurance, medical care, energy, taxes, and services rises, You did not stay still. You went backward. That is why the first mental shift is to stop measuring your wealth only in dollars. Measure it in purchasing power. Ask what your money can buy. Ask how much future income it can produce. Ask whether it is tied to productive assets or sitting in a form that can be diluted. That is the difference between a nominal thinker and a real thinker. A nominal thinker says, I still have $100,000. A real thinker asks, what does $100,000 buy now? And what will it buy 5 years from now? A nominal thinker says, my savings account pays interest. A real thinker asks, after inflation and taxes, am I gaining or losing purchasing power? A nominal thinker says, bonds are safe. A real thinker asks, what happens if inflation runs above my yield for years? That change in thinking is where protection begins. The next question is, what kinds of assets tend to survive and benefit in an environment where the currency is being diluted and real rates are being suppressed? The answer is not one asset. It is a mix. High-quality equities are one important category, but not all equities are equal. You want businesses with pricing power. That means businesses that can raise prices when their costs rise without losing their customers. A company with no pricing power gets squeezed in inflation. Its expenses rise, but its revenues cannot keep up. Its margins fall. Its stock may look cheap, but it can become cheaper. A company with pricing power can pass through inflation. It can preserve margins. It can grow nominal revenues. It can protect real earnings. That matters a lot in a financial repression environment. The second category is hard assets. Hard assets are things that cannot be created with a keystroke. Real estate, productive land, precious metals, energy infrastructure, selected commodities, and other scarce assets can behave differently from cash when currency is being diluted. They are not perfect. Nothing is perfect. Real estate can fall. Gold can be volatile. Commodities can be cyclical. But the principle is that scarce real assets are harder to debase than currency units. The third category is inflation, linked or shorter. Duration instruments that allow flexibility. I would be careful about locking too much money into long-duration fixed rate bonds when inflation risk is underestimated. Duration is a powerful force. It can help when rates fall, but it can hurt badly when inflation stays higher than expected and rates must adjust. The fourth category is optionality. Optionality means having enough liquidity to act without holding so much idle cash that your purchasing power is steadily eroded. This balance is important. Too little liquidity makes you fragile. Too much idle cash makes you a victim of the inflation tax. The goal is not to eliminate all risk. That is impossible. The goal is to choose the risks you are willing to own instead of being assigned risks by default. There is also a common mistake in the way people talk about international diversification. Some people say, if the dollar is going to be diluted, just buy foreign assets. That may help in some cases, but it is not a complete answer. Many developed countries have similar debt problems. Many central banks face similar incentives. Many currencies are being managed through the same basic pressures. So the asset class matters as much as the geography. Owning a weak foreign asset in a weak currency may not protect you. Owning a productive global business with real pricing power may. Owning real assets in a jurisdiction with weak rule of law may not protect you. Owning diversified claims on productive assets may. The key is not to chase a simple escape. The key is to build a resilient structure. Resilience comes from understanding the environment and not being overexposed to one outcome. This brings me to the traps. The first trap is long-duration bonds held without understanding real return risk. For decades, many investors were taught that bonds were the safe part of the portfolio. In many environments, that is true, but in a repression cycle, where inflation is allowed to run above interest rates, fixed payments can become a slow loss in real terms. You receive the dollars, but the dollars buy less. That is how bondholders can be harmed without a technical default. The second trap is too much cash. Cash feels safe because its nominal value does not fluctuate. That psychological comfort is dangerous. In the wrong environment, cash is not a safe asset. It is a melting asset. It melts slowly. That is why people do not react. A stock can fall 20% and scare you. Cash can lose 20% of purchasing power over several years and make you feel responsible because the number never visibly crashed. But economically, loss is loss. The third trap is concentration. Some people respond to inflation fear by going all in on gold. Some go all in on real estate, some go all in on stocks, some go all in on crypto, some go all in on cash because they fear everything else. That is not a plan, that is a personality reaction. The future is uncertain. Different assets perform under different scenarios. The purpose of diversification is not to maximize bragging rights in one year. It is to survive and compound through many environments. A well-designed portfolio should be able to handle inflation, disinflation, growth, recession, tightening, easing, conflict, technological disruption, and policy error better than a portfolio built around one emotional conviction. I have learned that most people do not fail because they do not know the perfect prediction. They fail because they build portfolios that only work if their prediction is exactly right. That is fragile. The world punishes fragility. Now, it is important to separate what is true from what is exaggerated. It is true that the debt burden is large. It is true that interest expense has become a major issue. It is true that financial repression has historical precedent. It is true that negative real rates help debtors and punish savers. It is true that central bank policy will play a major role in the next stage of the cycle. But it is not true that one person can simply wave a hand and cancel a debt burden of this size without consequences. It is not true that a specific interest rate path is guaranteed because of one speech or one viral video. It is not true that AI will automatically solve inflation. AI may reduce some costs, but it also creates large energy demand, capital, and social adjustment costs. It is a powerful force but not a magic wand. It is not true that the Fed chair acts like a monarch. The Federal Reserve operates through committees, institutions, constraints, market reactions, legal frameworks, and political pressure. The real story is less dramatic and more important. The debt problem creates pressure. The pressure shapes policy. Policy shapes incentives. Incentives shape asset prices. Asset prices shape who gets richer and who gets poorer. That is the chain. If you understand the chain, you do not need to react emotionally to every headline. You can watch the system and ask, what does this policy do? Who benefits, who pays? Which assets are helped? Which assets are harmed? What is discounted already? Where is the asymmetry? That is how you think like an investor rather than a spectator. Most people are spectators. They watch the news, they become angry, they argue about politicians, they blame the Fed, they blame Wall Street, they blame inflation, they blame someone else for the fact that they never built a strategy. Blame does not protect purchasing power. Understanding does. The practical approach begins with a clear inventory of your financial life. How much of your wealth is in cash? How much is in long-duration fixed income? How much is in productive businesses? How much is in hard assets? How much is dependent on one country, one currency, one sector, one employer, one income stream, or one policy outcome? Where are you fragile? That is the question I would ask first. Not, what stock should I buy tomorrow? Not, what did the Fed say today? Not, which headline is trending? The right question is, where would I be hurt most if the dollar loses purchasing power steadily over the next decade? Then you work backward. If too much of your net worth is sitting in cash, you do not need to panic. You need a plan to gradually convert some of that cash into assets that can preserve or grow purchasing power. If too much of your net worth is locked into long-duration bonds, you need to understand how real returns and duration risk work. If too much of your net worth is concentrated in one hot sector, you need to understand that even a correct long-term theme can produce devastating drawdowns if the entry price is wrong or the position size is too large. If you have no hard assets, no inflation hedges, no pricing, power businesses, and no diversified sources of return, you are making a bet. You may not call it a bet, but it is one. You are betting that the currency remains strong enough, inflation remains controlled enough, and policy remains friendly enough that cash and conventional nominal assets will protect you. Maybe that works. But in my view, the probabilities have changed. When probabilities change, portfolios should change, not emotionally, not all at once. Not by chasing whatever asset went up last month systematically. That word matters. The system is slow until it is fast. Debt problems can look manageable for years, and then suddenly the market begins to demand more compensation. Confidence can look stable until the cost of maintaining confidence rises. Inflation can look temporary until it changes behavior. Policy can look normal until the government has to choose between defending the currency and defending the debt system. Those choices are difficult. When policymakers face difficult choices, they usually choose the path that creates the least immediate visible pain. That is why gradual debasement is so common. It is politically easier to make money worth less than to directly tell people that benefits will be cut, taxes will rise dramatically, or debts will not be paid. This does not mean collapse tomorrow. In fact, the most likely outcome is not immediate collapse. It is a long period where money slowly changes value. Asset owners are rewarded, cash holders are punished, and most people feel confused because the nominal numbers keep rising while their real life feels harder. That is already how many people experience inflation. Their wages rise, but not enough. Their home value rises, but so do taxes and insurance. Their portfolio rises, but groceries, healthcare, and housing rise too. They have more dollars and less freedom. That is what happens when people measure the wrong thing. The solution is not fear. Fear makes people do stupid things. Fear makes people buy tops and sell bottoms. Fear makes people follow viral certainty. Fear makes people search for villains instead of mechanisms. The solution is principles. One principle is to preserve purchasing power over nominal. Another principle is to own assets that benefit from the direction of policy rather than being quietly damaged by it. Another principle is to diversify across asset classes, because no single asset is always right. Another principle is to keep enough liquidity to avoid forced selling, but not so much that inflation becomes your silent partner. Another principle is to avoid leverage that can destroy you before your thesis has time to be right. Another principle is to understand that cycles take time. If financial repression unfolds over a decade, a one-month market reaction is not the story. The story is the compounding transfer of value over time. That is how wealth moves in debt cycles. It does not usually move because one video was right or wrong. It moves because millions of people are positioned incorrectly for the environment they are in. If you are a saver, you must understand that saving alone is not enough when the currency is being debased. If you are an investor, you must understand that growth alone is not enough. If you pay any price for it, if you are retired, you must understand that income alone is not enough, if that income does not keep pace with the real cost of living. If you are young, you must understand that volatility is not your biggest enemy. Your biggest enemy is failing to acquire assets while the system is designed to reward asset ownership. If you are wealthy, you must understand that preservation requires more than avoiding visible losses. It requires avoiding silent, real losses. That is the point. The machine is not moral, it is not kind, it is not designed around your comfort. It responds to debt, incentives, political constraints, and institutional survival. Once you understand that, you stop taking it personally. You stop asking the system to be fair. You start asking how it works. And when you know how it works, you can position yourself with much more clarity. The debt problem is not going away because people are tired of hearing about it. The interest problem is not going away because politicians stop talking about it. The purchasing power problem is not going away because your bank shows you a stable balance. Reality does not disappear when it becomes inconvenient. The United States has navigated major debt burdens before. It may do so again, but the way it navigates them matters enormously to households. After World War II, those who held the wrong fixed claims lost purchasing power. Those who owned productive assets and real assets did much better over time. That is not a coincidence. It is the logic of the cycle. So when you hear people say that a new Fed chair has a plan to cancel the debt, translate that phrase into something more accurate. The debt will not be canceled in the dramatic way people imagine. It may be diluted, it may be managed, it may be inflated against, it may be repressed through policy choices that make the real burden smaller while the nominal number remains large. That is more boring than a viral headline. It is also much more important because if the debt is diluted, the question becomes, What are you holding while the dilution happens? If you are holding mainly cash, you are the funding source. If you are holding long-duration low yield claims, you may be the funding source. If you own productive assets with pricing power, scarce assets, and a balanced structure that can survive multiple outcomes, you are more likely to be on the right side of the transfer. That does not mean guaranteed wealth. Nothing guarantees wealth. It means the odds are different. And investing is about odds. This is why I would rather be approximately right about the structure than precisely wrong about the date. Do not obsess over whether a handover happens in May. Do not obsess over whether the exact policy rate becomes one number or another number. Do not build your whole financial life around one politician, one central banker, one election, one viral claim, or one prediction. Build around the structural reality. Debt is high, interest expense is high. Political willingness to cut deeply is low. The incentive to use inflation and negative real rates is strong. Asset owners tend to be protected better than cash holders. That is enough to act intelligently. The next decade will likely punish people who confuse stability with safety. It will likely reward people who understand that real wealth is not a number in a bank app. Real wealth is control over future goods, services, time, choices, and resilience. That kind of wealth must be protected in real terms. If you do nothing, that is still a decision. Doing nothing means you accept the default position the system has assigned to you. Maybe that default position is fine, but you should know what it is. You should know who benefits if inflation runs above your yield. You should know who benefits if interest rates are held below the real loss of purchasing power. You should know who benefits if asset prices rise while wages and savings lag behind. Because if you do not know who benefits, there is a good chance you are the one paying. I do not say that to scare you. I say it because reality is useful. The people who succeed in cycles are usually not the people with the loudest opinions. They are the people with the clearest maps. This is the map. A major debt burden creates pressure. The pressure creates policy incentives. The policy incentives favor dilution over default. Dilution favors assets over cash. The transition rewards those who move early and systematically and punishes those who wait for official permission. No official will tell you the exact moment to reposition. No news anchor will say, "Today is the day your savings stop being safe in real terms." No central banker will say, "We are now transferring purchasing power from savers to debtors." They will speak in technical terms you must translate. That is what financial education is. It is translation. It is seeing the real mechanism behind the polite words. The polite word is inflation. The mechanism is purchasing power transfer. The polite word is negative real rates. The mechanism is savers subsidizing borrowers. The polite word is financial repression. The mechanism is debt reduction through controlled loss of real value. The polite word is monetary flexibility. The mechanism is giving policymakers room to debase. When you can translate, you can protect yourself. And when you protect yourself, you do not need to be angry. You do not need to be ideological. You do not need to believe in collapse. You simply need to be realistic. The system will do what systems do. Your job is to understand it, not worship it. Your job is to build a life that is not destroyed by it. Your job is to own assets that are aligned with the direction of the cycle, while keeping enough flexibility to survive being early, wrong, or surprised. That is how I would think about the coming period, not with panic, not with certainty, with principles. Because principles are what keep you from being manipulated by headlines. And in an age of debt, inflation, central bank intervention, and political theater, the person with principles has a tremendous advantage over the person with opinions. The next time you hear someone say that America's debt will be canceled, do not take the phrase literally. Ask how, ask who pays, ask through what mechanism, ask what happens to cash, ask what happens to bonds, ask what happens to businesses with pricing power, ask what happens to hard assets, ask what happens to people who wait until the process is obvious. By the time it is obvious, much of the adjustment may already be priced in. That is how markets work. They move before most people understand why. So I would not wait for permission. I would not wait for permission. I would not wait for the perfect forecast. I would start by understanding my exposures, measuring my wealth in purchasing power, reducing avoidable traps, diversifying across real and productive assets, and building a strategy that can survive a decade of quiet currency dilution. That is not dramatic. It is not exciting. But it is the kind of thinking that protects families. It is the kind of thinking that separates those who are financially acted upon from those who are financially prepared. And in the end, that is the real choice. You can let the machine run over your savings quietly, or you can learn how the machine works and stand where the pressure is more likely to help you than hurt you. The machine will not stop, the cycle will not wait, and the dollar in your account will not protect itself. You have to think clearly before the crowd is forced to. That is how wealth is preserved. That is how opportunities are found. And that is how you avoid becoming the person who realizes too late that the debt was not canceled by magic. It was paid for by the quiet erosion of everyone who failed to understand the game.